It wasn't a glitch, it wasn't a mistake, it wasn't even a simple market correction, it was the inevitable liquidation of a leveraged illusion. The pattern is unmistakable, the arithmetic is merciless. We see a flash crash in silver 30% in a single day. Commentators call it volatility. Regulators call it a liquidity event, but history calls it something else entirely. It calls it the snapping of the tether. The moment when the paper map no longer matches the physical territory. Most observers agree that the modern precious metals market is a dual system. There is the physical metal heavy finite hard to move, and then there is the paper derivative infinite frictionless leveraged. When these two worlds collide, violence ensues. The price action we see today is not random. It is the result of a structural mechanism that has repeated for centuries, a mechanism where the state and the financial sector expand claims on wealth far beyond the actual wealth that exists. The incentive is always the same: to spend what has not yet been earned, to borrow against a future that may never arrive. The payoff is immediate liquidity and political survival. The risk is a chaotic unwinding that destroys the unsuspecting holder of paper promises. Under these constraints, the rational move for the central planner is to suppress the warning signal to manage the price, to create a paper buffer that absorbs the demand for the real thing. But the pattern shows us that this suppression has a mathematical limit. We are going to look at 3 specific historical case studies that prove this. We will examine the Spanish Empire, the British Empire, and the Weimar Republic. In each case, we will see the same sequence: peak dominance, unsustainable costs, a chosen monetary shortcut, and finally, the brutal revaluation of reality. Just like the Spanish Empire, we begin with the illusion of infinite wealth. Consider the Spanish Empire in the 16th and 17th centuries. This was the first true global superpower, an empire on which the sun never set. It was fueled by a singular, overwhelming commodity: silver from the deep, suffocating mines of Potosi in present-day Bolivia and Zacatecas in Mexico. The Spanish galleons transported literal mountains of silver back to Europe. This influx was unprecedented in human history. It was supposed to make Spain the wealthiest nation on earth forever, but it didn't. Instead, it created the first modern example of a financialized crash. The Spanish crown, led by rulers like Philip II, fell into a trap that modern investors would recognize instantly. They confused the flow of money with the creation of wealth. Seeing the silver arriving in Seville, the crown began to spend it before it even arrived. They issued bonds known as juros, which were essentially paper claims on future silver shipments. This was the 16th century equivalent of a futures contract. The crown leveraged its income, borrowing heavily from Genoese and German bankers to fund endless wars in Flanders and against the Ottoman Empire. The leverage ratio exploded. By the 1570s, the crown's debt payments consumed more than the total value of the silver arriving from the Americas. The paper claims on silver exceeded the physical silver available. Sound familiar? The result was not stability, but a series of catastrophic defaults. Philip II, the most powerful man in the world, declared state bankruptcy in 1557, 1556, 1575, and 1596. Each time, the value of the paper promises crashed to zero. The investors who held paper claims on Spanish silver were wiped out overnight. Meanwhile, the physical silver itself lost purchasing power in what historians call the price revolution, because there was so much metal flooding the system, but no increase in productive goods. Prices for wheat, cloth, and land skyrocketed. A shoemaker in Castile saw his cost of living triple. Even as the empire drowned in silver, the middle class was hollowed out, priced out of their own economy by the inflation caused by imperial mismanagement. The lesson here is critical. Even when you own the physical source of the money, leverage and debt can force a collapse. The paper market for Spanish debt crashed repeatedly, wiping out fortunes, while the physical metal flowed through Spain like water through a sieve, ending up in the hands of the productive Dutch and English. Just like the Spanish Empire, the British Empire eventually faced the consequences of maintaining a global standard with insufficient reserves. By the early 20th century, the British pound sterling was the world's reserve currency, backed by gold and silver. It was the bedrock of global trade, considered as good as gold. But the costs of World War I shattered the arithmetic. To fight the war, Britain had to print money and issue debt on a scale that dwarfed its physical gold and silver reserves. They suspended the convertibility of paper notes into metal. For 4 years, the link was broken. When the war ended, the British political elite led by Winston Churchill as Chancellor of the Exchequer in 1925, made a fateful decision. They decided to return to the gold standard at the pre-war parity. They wanted to pretend that the inflation of the war years hadn't happened. They wanted to restore the paper value of the pound to its old physical weight. This was a form of reverse leverage, an attempt to force the paper reality to align with a physical reality that no longer existed. The result was a deflationary depression that ravaged the British. Working-class coal miners, dock workers, and factory hands saw their wages crushed to support the strong pound. The incentive for the government was prestige and the preservation of the City of London's financial dominance. But the market knew the truth. Foreign central banks and savvy investors knew that Britain did not have enough physical gold to back the paper pounds in circulation at that price. The breaking point came in 1931. A run on the pound began. It was a liquidity crisis of the highest order. Investors rushed to exchange their paper claims for physical metal. The Bank of England's reserves drained at an alarming rate. On September 19, 1931, the bank was hemorrhaging millions of pounds in gold per day. The leverage was exposed. On September 21, Britain suspended the gold standard. The pound crashed immediately. In the days that followed, the currency devalued significantly against gold and silver.
Those who held paper pounds lost massive purchasing power overnight. Those who held physical gold and silver preserved their wealth. The fraud of the 1925 parity was exposed by the merciless arithmetic of the market. The paper promise could not survive the liquidity drain. Just like the British Empire, the Weimar Republic provides the ultimate lesson in the decoupling of paper price and physical value. We often think of Weimar hyperinflation as a straight line up, but it was actually a volatile, chaotic series of crashes and rallies driven by speculation, leverage, and despair. By 1923, the German mark had lost its tether to reality. The government, burdened by unpayable war reparations and a decimated industrial base, turned to the printing press. This is the classic monetary shortcut. But here is the key detail often missed. The volatility. As the currency collapsed, the paper price of silver and gold exploded. But it wasn't a smooth ride. There were days of massive corrections, liquidity crunches, where paper fortunes vanished. Speculators would borrow paper marks to buy hard assets, creating a massive leverage bubble. When the Reichsbank tightened credit even slightly, or when a political rumor circulated, the paper price of assets could swing wildly. Imagine a clerk in Berlin in October 1923. He receives his paycheck at 11 a.m. By 12 p.m. The price of a silver coin has doubled. He rushes to buy anything: bread, shoes, a train ticket. The velocity of money went to infinity, but for the sophisticated traders, the game was shorting the currency. They borrowed marks, bought silver or foreign currencies, waited for the mark to crash, and paid back the loan with worthless paper. This was the inflation trade of the century. However, the crash came for the paper currency itself. In November 1923, the system reset. The Rentenmark was introduced, backed ostensibly by land and industrial goods. The old paper marks were demonetized, trillions were wiped out. But the physical silver coins from the German Empire era, they retained their value. A family that had kept a jar of silver, Reichsmarks, under the floorboards could buy a city block in the chaos, while their neighbors, with wheelbarrows of paper money, starved. The fraud was the paper mark itself. The crash was the market returning to the only reality that mattered: physical scarcity. The pattern repeats in 7 distinct stages. Stage 1 is the financialization of the real. The society moves from using physical money to using paper receipts for money. At first, this is convenient and efficient. Trust is high and the ratio of paper to metal is 1:1 stage. 2 is the expansion of leverage. Politicians and bankers realize they can issue more paper claims than there is physical metal. They use this excess liquidity to fund wars, welfare, or corporate bailouts. The ratio slips to 2:1, then 10:1. The public does not notice because the paper still spends like metal. Stage 3 is the false stability. The increased liquidity creates a boom. Asset prices rise, the stock market soars, the paper-silver market is born, where contracts representing silver are traded without any metal ever moving. This suppresses the physical price as demand is satisfied by paper promises. Stage 4 is the warning tremor. A minor crisis exposes the lack of physical reserves, a bank fails, or a war breaks out.
Smart money quietly exits the paper market and takes delivery of physical assets. The premium for physical metal over the spot price begins to widen. Stage 5 is the liquidity shock. This is the crash stage. A major external event forces a scramble for cash. Leverage speculators receive margin calls. To cover their debts, they must sell everything: stocks, bonds, and even their paper precious metals positions. This selling pressure drives the spot price of silver down violently, even as demand for physical silver explodes. This is the 30% drop. It is a paper liquidation event. Stage 6 is the decoupling. The paper price crashes, but the physical price disconnects. Dealers run out of stock. Premiums skyrocket to 50% or 100%. The screen price says silver is cheap, but you cannot buy an ounce for that price anywhere in the real world. The illusion breaks. Stage 7 is the revaluation. The paper market eventually collapses or is forced to reset. The price of the physical asset is revalued to reflect the actual supply of money in the system. This is the vertical move that wipes out the short sellers and restores the historical equilibrium. Just like the liquidity shocks of the past, current data suggest we are living through a stage 5 event in the silver market. This brings us to the specific mechanics of the 30% crash and the accusations of fraud. To understand this, you must understand the structure of the COMEX and the London bullion markets. These are the primary venues where the price of silver is discovered, but they are not markets for silver. They are markets for contracts representing silver. Estimates range, but many analysts argue that for every ounce of physical silver in the registered vaults, there are hundreds of ounces of paper claims traded. This is the definition of leverage. Large institutional players, bullion banks, and hedge funds trade these contracts with massive leverage. They might put down only 5% or 10% of the cash value of the contract. So how does a crash happen? It usually starts with a liquidity event elsewhere in the economy, a stock market drop, a bond yield spike, or a geopolitical scare. When these funds lose money in stocks or bonds, their brokers issue a margin call. They demand immediate cash. The funds are forced to sell their most liquid assets to raise that cash. Silver futures are highly liquid, so they dump billions of dollars of paper silver in minutes. This selling drives the price down. As the price drops, other leverage speculators hit their stop-loss limits. Their computers automatically sell to prevent further losses. This creates a cascade. Selling begets selling. The price falls off a cliff: 10%, 20%, 30% in a single session. This looks like a crash. It feels like a crash. But notice what hasn't changed. The physical inventory. The mines didn't disappear. The industrial demand for solar panels and electronics didn't vanish. In fact, during these crashes, physical buying often accelerates. This is why many observers call it a fraud. They argue that the price is being determined by the liquidation of paper bets, not by the supply and demand of the metal itself. The incentive for the bullion banks is to facilitate this volume, collecting fees on every trade and often taking the other side of the trade, buying the dip when the funds are forced to puke their positions. The counter-argument is that this is simply an efficient market pricing in deflation or recession risk. Economists would say that if traders believe the economy is slowing, industrial demand for silver will fall, so the price should drop. But this argument fails to account for the physical disconnect when the paper price crashes 30%, but physical dealers increase their premiums and cannot keep stock on the shelves, the efficient market. Hypothesis is broken. The price on the screen has become a fiction. It is the price of a paper promise that is being liquidated, not the price of the metal itself. The endgame for this dynamic follows a predictable path. Controlled decline, chaotic collapse, or reset and restructure. The first possibility is a controlled decline. The regulators and exchanges raise margin requirements. They make it more expensive to trade paper silver. This slowly deleverages the system. The paper open interest shrinks, and the price gradually realigns with physical reality. This is the soft landing scenario, but history suggests it is rare. The incentives to keep the casino open are too high. The second possibility is a chaotic collapse. This is the short squeeze scenario. A major entity stands for delivery. They buy the paper contracts, but instead of rolling them over or settling for cash, they demand the physical bars. If enough players do this simultaneously, the exchange defaults. They declare force majeure. They admit they don't have the metal. In this scenario, the paper market shuts down. The price of silver goes no bid on the screen, while in the private market it trades at multiples of the old high. This happened in the nickel market recently. The precedent is already there. The third possibility is a reset and restructure. This is the most likely historical outcome. The currency itself is reformed. A new digital dollar, or CBDC, is introduced as part of the transition. Gold and silver are revalued to a much higher price to collateralize the new system's balance sheet. We saw this in the U.S. in 1934 when gold was revalued from $2,067 to $3,500 overnight by executive decree. The paper losses were locked in. The physical holders were the new kings. The only variable is timing and pain. If you are watching the screen price and feeling panic, you are looking at the wrong indicator. You are watching the liquidation of a leveraged bet, not the value of a strategic asset. The history of Rome, Spain, Britain, and Weimar screams the same warning. Paper burns, metal endures. Subscribe to the channel. Educate yourself on the difference between the spot price and the physical price. Watch the inventory levels at the exchanges, not just the daily candle. Build resilience into your position. The volatility is not the bug. It is the feature of a system running out of collateral. Be ready.